Good evening, traders. This is the continuing series of stock options and futures. And this video is probably going to be the longest video that I make in this series. It's going to be about options trading, and the reason it is on the surface, options seem pretty simple. There's two types of options: a call or a put, and you can buy them or sell them. I mean, it's just like a stock, and the object's the same. You want to buy it for a low price and sell it for a high price. But with that said, I'm going to dig into it a little bit deeper, go into some of the different types of options trades you can make and why you would make them. There is no one trade that works all the time, no one type of trade that works all the time. So I'm just going to, I'm not going to go really in depth, but I'm going to give you enough to give you an understanding of different types of options trades and why you would do them. The first here you would see is a call. If you're the buyer of the call, you can call the stock away from somebody. For example, if you buy a call on a stock, say you buy the $50 call, and the stock's maybe say 47, 48, and it goes up to 55, you get the opportunity to force the person to sell you the stock at the $50. Okay, so you can call the stock away from that person at the set price that you bought the call at. If you're the call seller, you can have the stock called away from you. So for in this example, like say the first one here, you purchased the call, so somebody had to sell you that call. So he was a call seller. Well, he sold you a $50 call when the stock was 47. You were thinking it's going to go above 50. He was thinking it was not. Okay. Well, when the stock went to 55, you called it away from him. He is obligated to sell you that 100 or deliver that 100 shares at $50. Or you could just sell the call for profit. You don't have to actually physically take delivery of the stock, but that is an option for you to do. Okay. Puts. If you're the buyer of the put, you can put the stock to somebody. Example, we'll use the same, the stock, you buy a $50 put when the stock say at $51 or $52 because you think it's going down. So if the stock goes down to 45, you can put it to somebody at $50 a share. Okay. The put, if you're the seller, the stock can be put to you. Same as the call. When you bought the put, somebody had to sell you the put. Well, I sold you the $50 put when it was $52, and I'm thinking it's going to stay above that, but it went to 47. Now I'm going to be the new owner of a stock that's worth 47 at $50. Okay, types of trades. I'm going to kind of talk a little bit here about the type of trade it is when you make a certain trade. Okay, if you buy a call, that's bullish because you're buying a call, say of a stock, you're buying the $50 call when the stock's at 47, so you want it to go up. When it goes up, your calls become worth more money, and so that's a bullish bet. You're saying, I believe the stock's going up, I'm going to buy a call. And typically you buy them above the current price. Stock was at 50, you'd buy like a 52 call, hoping it would run up to the 52 and really get you a lot better return than if you bought a 47, which was already in the money because stock's already at 50. So you're going to pay a lot more for the call. So you typically buy the call above the price, which is called out of the money. To sell a call is a bearish trade. If the stock's at 50, you would typically want to sell a call, say at 52, above it with the anticipation that it's going to go down. Okay. And you could actually sell a call that's in the money. Stock's at 50. You could sell a 47 with the anticipation it's really going to go down and go below your 47 and collect more premium. But you typically sell it above with the idea it's going down. If you buy a put, that's bearish. Same thing. You're buying the put which gives you the right as a put buyer to put it to somebody at a predetermined price, with you thinking it's going to go down would be the time you'd buy a put. Sell a put is bullish. You sell a 47 put when it's at 50 with anticipation it's going to stay above the 47, so you keep all the premium. The next is a call spread. Call spread is bearish, and typically you would sell a call spread above the current strike price. And when you buy or just sell a put, you have to put up. If you just sell naked puts or naked calls, that's what they call the undefined risk. In other words, if you sold a 50 call and the stock went up to $100, you would take a $5,000 loss. So you have to put up a lot of money. So if you were talking about a stock, say Apple, which is around $150 last time I looked, you'd have to put up a lot of money in order to sell a naked call in Apple. So one way to kind of get around that, to allow you with a smaller account to put on the same type of trade with a lot less capital involved, would be to sell a call spread. And what you would do, we'll take Apple again, and we'll just say it's $150. You would sell a call spread by selling the short call at, say, $155 and buying the long call at $160. Now you get to keep the premium, and that might be, $1.50, $1.75, whatever. The most you can lose on that is the difference of the $5 in between the strikes minus the premium you collected. So if you collected $1.50, the most you could lose would be $3.50, which would be $350 on that trade. But that allows people with smaller accounts, or people that just don't want to risk the unlimited risk type trade, to trade high dollar stocks. Amazon is $1,200 or $1,300, something of that nature. This would be the type of trade that most people would use to trade those big stocks. A put spread is a bullish trade. If the stock is at 150, you would say sell short the 145 put and buy the 140 for protection. Same thing as we just talked about on the call spread. Your maximum risk is the difference of the spread, which is $5 minus the premium collected. Now we have what's called a calendar trade. And a calendar trade is all options have time value. And every day as they get closer to the option expiration date, they lose a little of that value in time. And a calendar spread is kind of a neutral trade that you try to take advantage of this time decay in the options. And what you would do, we'll take, say, a $50 stock. You would sell a $50 put or call, either way. Let's say 2 weeks to go. And you would buy the same $50 put or call. You do them both the same, puts or all calls, say 4 weeks away. And this is a definitive risk trade, because you're going to start the trade by buying the calendar. Okay, and let's just say you paid $1.50 for it. So the most you can lose, regardless if it goes all the way from $50 to $100, it goes from $50 to zero, the most you can lose is $150. But what you're trying to do is you want the stock to stay relatively close to the $50 mark where you bought the calendar, and collect the time decay. And most of the time, you just look to take about a 10% win on this. So on a $150 trade, you'd look to make about $15 and get out. Okay? Iron Condor is a neutral trade. And what Iron Condor is multiple legs. This is 4 legs. And this is a neutral trade. Let's take that Amazon stock again with around, say, $1,300 a share. You're going to simultaneously sell a put and call spread. The call spread above the current price, the put spread below it. Let's say you're going to go $50 each side. So you would sell the $1,250 put, sell the $1,350 call, and buy one, say, $5 or $10 above that for the protection. That limits the amount of maximum loss. And if it stays in between these two strikes, the $1,250 and the $1,350, your two short strikes, you could collect all the premium. But it's a good rule of thumb on these neutral trades to close it out when you make 50%. So if you initially sold this thing for $3, if you got to collect $150 of profit, take your money and run. A strangle is a neutral trade. It involves two legs. It's basically the same thing as this iron condor, but it's unlimited risk. In other words, we'll take the $50 stock. You would sell a $40 put and a $60 call, $10 above, $10 below, just as an example. And you would collect more premium because you're not buying the two options above it or below it for protection. And you hope that it stays in between the 40 and the 60. A straddle is kind of a neutral. Now, what a straddle does is you sell the $50 stock, you sell the $50 call and the $50 put. And let's say you collect, $3. You hope it stays within $3.50. So it could go down to like your profit target range is from 47 on a low to 53 on a high. Anything more of that, you're going to lose money on this trade. Iron fly. It's kind of the same thing as iron condor, but it also kind of sets up like a straddle because your two short strikes are going to be at the money. For example, let's take a $50 stock again. You sell the $50 call, the $50 put, but then you might want to go out and buy the $40 put and the $60 call, $10 away, to limit your risk in case this thing goes, against you big time. A butterfly, this is an option strategy that involves three different options. What you do is, let's take the $50 stock again. You might sell the $50 put two times and buy two different calls. One, like say 48 and one 52, and you're kind of hoping it stays bearish. You're going to collect a little credit on this to start with, but it has a sweet spot in it. If it expires right at the 50, your short strikes, you can make a pretty good sized payday on it, like 3 times the credit, okay? But if it goes above it, the losses can be big too. So you want to analyze a butterfly trade before you put it on. And the call is kind of the same way. It's just bearish. It has a sweet spot in there, where if it lands on your two short calls that you sold, you collect a lot of premium, make some big money. But again, it can go against you as well. So you always want to analyze those before you put those type of trades on. I hope this gives you, again, this is just kind of a general rules, food for thought on options. And hopefully it'll get you to look and explore some different opportunities in options tradings and broaden your trading knowledge. Good luck to you out there.